What's up everyone, it's Caddy with Money Vesting. In this video, I wanted to break down the earnings so far. 6% of S&P 500 companies have reported earnings. So I also want to break down the banks a little bit and then talk a little bit about where we are in this earnings season, what the expectations are for the first quarter 23 and for the remainder of 2023 in terms of calendar year, what expectations we have with analysts forecasting for the rest of 2023. So hope you guys enjoy this video and find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel. If you're just joining us for the first time, we talk a lot about fundamental analysis, technical analysis, macroeconomics, and stocks and options. So all of that is going to be covered and linked to our Discord and Patreon down below with the 16% annual discount available till the end of this month. So as I said earlier, overall 6% of S&P 500 companies have so far reported actual results for the first quarter 2023, most of them being, of course, banks. And of these companies, 90% have actually reported EPS above estimates, which is above the 5-year average of 77% and above the 10-year average of 73%. So we're definitely starting off the earnings season in the right way. Like, we're starting off on the strong footing, thanks to, unfortunately, the Silicon Valley Bank collapse. Because that happened, deposits flew out of Silicon Valley Bank, flew into big banks, and as a result, they were able to capitalize with higher profits, higher revenues, and higher earnings as well. In aggregate, companies are reporting earnings that are 7.9% above estimates, which is below the 5-year average of 8.4%, but above the 10-year average of 6.4%. So I'd say that's about neutral. And the index is reporting higher earnings for the first quarter today, relative to the end of last week and relative to the end of the quarter in Q1 as well. And the blended earnings decline for the first quarter is right now standing at 6.5%, meaning that S&P 500 earnings are still expected to decline in the first quarter 23 by 6.5%, and that is still a slight improvement from 6.9%. That was the last week number, and earnings decline of 6.7% at the end of the first quarter. So we're slightly improving in terms of the earnings expectations for first quarter. And if 6.5% is the actual decline for the quarter for first quarter 2023, it will mark the largest earnings decline since the second quarter of 2020 when the pandemic hit and earnings absolutely collapsed by 31.6%, and will also mark the second straight quarter in which the index has reported a decrease in earnings, because we know that fourth quarter 2022 was also a decline in earnings per share. And if we see another quarter, which is going to be Q1 of 2023, a decline, well, that is going to be 2 quarters of negative decline in earnings per share on a year-over-year basis, hence an earnings recession. 5 of the 11 sectors are expected to report year-over-year earnings growth led by consumer discretionary and industrials. And on the other hand, 6 sectors of those 11 are expected to report year-over-year declines in earnings per share, led by materials, healthcare, information technology, and comm services as well. In terms of revenue, now this is what's really interesting, 63% of S&P 500 companies have reported actual revenues above estimates, which is below the 5-year average of 69%, but equal to the 10-year average of 63%. So we're really still seeing consumers spending enough because revenue growth is still there. On an aggregate basis, the revenues being reported are 2.3% above estimates, which is above the 5-year average of 2% and above the 10-year average of 1.3% as well. Positive revenue surprises reported by companies in the financial sector have been the largest contributor to the increase in the overall revenue growth. That's not a surprise because, well, financial stocks reported some very good numbers. And on the back of that, JP Morgan, Wells Fargo, Bank of America was going to report next week, but Citigroup, they were all pushing higher on that day. And looking ahead for the remainder of 2023, analysts still expect earnings growth for the second half of 2023. For Q2 2023, analysts are projecting an earnings decline of 4.6%. So that's going to be 3 consecutive quarters of decline, 6.5% this quarter and another 4.5% in the second quarter. But for third and fourth quarter, analysts are projecting growth of 1.9 and 8.8% for the remainder of this year. For the entire calendar year 2023, analysts project an earnings growth of just about 0.9%. So that's what the expectations are right now. These are some of the charts that I wanted to also break down. And again, you can see that only 6% of the S&P 500 has actually reported their numbers. Consumer discretionary, all the companies that have reported, 100% of them above expectations in terms of EPS. We got consumer staples, 100% of the companies reporting above expected EPS. Healthcare also a perfect record so far. Fewer companies being reported right now, so obviously still a perfect record. And then information technology, 75% reporting above estimates, 25% below expectations, and of course S&P 500 overall 90% reporting EPS, which is above estimates. This right here is going to be the revenue. So again, you can see S&P 500, 63% of companies reporting revenue estimates that are above the actual expectations and 37% below. Industrials definitely not performing the best. 40% of them are the ones that are reporting above estimates and 60% below estimates, and healthcare is still the perfect record. And in my other video, I talked about how there is money flowing into healthcare right now, right? Bank of America Global Research, we talked about how money is actually flowing into healthcare. That's one of the reasons why revenue and earnings are coming in above expectations right now. This is going to be the earnings growth projected in the first quarter 2023. S&P 500 negative 6.5%. That's what the consensus is. And the biggest losing sectors in this quarter are going to be utilities, comm services, IT, healthcare, and materials. And then we got consumer discretionary, industrials, energy, and financials kind of leading the way in this quarter. This is going to be revenue. Again, energy, IT, utilities, and materials, kind of like the ones that are dropping the most in terms of year-over-year growth. And we got financials charging higher. They're the ones leading the way, followed by discretionary, industrial, real estate, and consumer staples as well. These are going to be some record revenues reported by companies. So JP Morgan posting a record revenue on higher interest rates, shares jumping over 7%. So EPS came in at $432 versus $341, and revenue came in at just shy of $40 billion. And banks' profits jumped over 52% to over $12.6 billion to $410 per share. And company-wide revenue rose 25% to almost $40 billion. Banks are absolutely raking in the cash. This is going to be Wells Fargo $1.23 versus 90 cents expected, and revenue came in at over $20.7 billion versus just over $20 billion expected. And the net income profits increased by over 30% to nearly $5 billion for Wells Fargo. And Citigroup also reporting personal banking revenue rising over 18% with $4.6 billion in net income compared to $4.3 billion. And $21.4 billion in revenue versus almost $20 billion. So needless to say that it's been a very strong start to the earnings season, but tech is really what's going to matter because they're the ones that concentrate the index quite a lot. And this is where the expectations put us in terms of the actual PE multiple, the valuation for the market. So right now, as of the close on Friday, we're at 41.37. That's the S&P 500 value. And at $210, potentially, well, we're going to be sitting at roughly around 19.7 to as much as 20 times PE multiple. And on a trailing basis, we're trading at a little bit over 19 as well, which, again, you can be the judge of that, whether this is an overvalued, undervalued, fairly valued market for you. You can be the judge. You can decide what's appropriate. But for me personally, it's a little bit more on the higher end when it comes to the valuations. It's a bit more stretched to the upside. I'd be a lot more interested closer to 14, 15 times earnings. That's kind of like my sweet spot. But there's also a lot of deals out there individually that I can still take advantage of. So let me know your thoughts down in the comment section below. Earnings season getting started with a pretty much a big bang here. Very strong numbers being reported by financials, and we are beating expectations right now, but we're still expected to decline by 6.5% in earnings for the first quarter of 23, which will be 2 consecutive quarters of earnings decline, which could technically put us into an earnings recession. So let me know your thoughts down in the comment section below. As always, if you enjoyed this video, found it helpful, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. The link to our Discord and Patreon is going to be down below. As always, happy investing, and I'll see you all in the next video.